Hello, my name is Clive Corcoran, and in this video I want to discuss the infamous JP Chase Whale Trade debacle, which occurred in 2012 and exemplifies some key failures in risk management and governance and risk culture within the bank. I am recording this screencast for my YouTube channel, the Corcoran Codex, where I look at a number of critical ideas and episodes in the world of finance. Let me give some background to the London whale debacle. JP Chase and Company is the largest financial holding company in the United States, with approximately 4 trillion in assets as of the end of 2024. The bank is the largest derivatives dealer in the world and the largest single participant in credit derivatives markets. It has previously assured stakeholders that there was nothing to fear from its banking activities, including its extensive dealing in derivatives. In early 2012, the bank's CIO, based in New York, which was charged with managing $350 billion in excess deposits, instructed its trading team in London to place a series of massive bets on a complex set of synthetic credit derivatives. And during the course of 2012, this portfolio lost at least $6 billion. And moreover, there were major lawsuits, fines, and penalties. Now, the nature of the incident was such that it attracted the attention of the US Senate, and a subcommittee within the US Senate decided to launch an investigation into what had gone wrong, the circumstances surrounding this whale trade debacle. They eventually published a report, the front cover of which can be seen over here, and it is a fascinating report. It is quite a long report, about 400 pages. One wouldn't need to read it in full, but it makes for very interesting reading, and scanning it could be very worthwhile. If you want to obtain a copy of the report, it's found in a number of places. This particular URL here down at the bottom would be one place to find it. What were the findings of that report published by the Senate subcommittee? So they determined that during the course of 2012, starting at the beginning of the year, JP Chase used its synthetic credit portfolio, essentially a trading book which contained various credit derivatives, index products based on credit default swaps, and so on. I'll say a bit more about that in a moment. And the bank engaged in high-risk derivatives trading. It mismarked the book to hide hundreds of millions of dollars of losses. It disregarded multiple internal indicators of increasing risk. It manipulated models, dodged the oversight of the US supervisor of the banking system, the OCC, and misinformed investors, regulators, and the public about the nature of its risky derivatives trading. During the prior year, 2011, traders in the London office of JPM managed to earn a windfall profit for the bank of more than $450 million as a result of speculating, taking bets essentially in the credit index market, which consists essentially of a large number of credit default swaps. These have been discussed elsewhere on my YouTube channel, and they were buying protection against defaults of various corporate bonds. In one case, they had a large position where they had sought protection in an index of US high-yield companies, essentially companies that issue junk bonds. And during the course of 2011, American Airlines and company Dynegy both defaulted, and that resulted in this very sizable gain to the bank as a result of the activities of Bruno Ixel and his team of traders. And that made the people in New York very favorably disposed towards allowing Bruno Ixel and his team to continue trading these synthetic credit derivatives. As can be seen on the slide now, there was a massive expansion in the trading book, the synthetic credit portfolio. So during the course of 2012, it more than tripled, and by March of 2012, the book included a position of $60 billion plus in holdings in a US credit index for investment grade companies. Those are companies deemed by the ratings agencies, Moody's and Standard and Poor's and so on, of being of high credit quality. 70 plus billion in holdings of a similar index for European investment grade companies, and more than 20 billion in holdings in a credit index product which specialized in sub-investment grade companies or high yield, or sometimes called junk bonds. That index, in fact, was the same one where ICSL had managed to deliver the $450 million profit from the last slide. Now, on this slide, we have text directly from the subcommittee's document, and they give some examples of the kinds of derivatives involved in these trades. So here, for example, we can see a product issued by this company, Market. And among Market's various products, we can see this one, CDX.NA.IG.9. And this CDX refers to a credit index. NA refers to North America, IG to investment grade, and the number 9 is just a number within a series of such credit index products. And as it says, Market issues this index every 6 months, and it contains 125 constituent credit default swaps. So in essence, there are 125 investment grade and North American companies covered, each one of which has a single name CDS in effect. And if you put all these into a basket, you thereby create a credit index product, and you can either buy or sell protection on that group of companies. And in fact, the traders in London were moving their trades around from time to time, being both long and short this particular credit index product. Now, during the course of 2012, as can be seen on the table here, and this table was part of the subpoena process where the Senate subcommittee was able to demand whatever documents they wanted from JPM. And you can see here that during the course of 2012, the losses started to mount considerably. So they moved from relatively minor, 100, 700. By May of 2012, this had come to 3.5 billion. And by the end of 2012, there is a number in excess of $6 billion of actual realized losses from the trading activities by the London team. Let us consider some more of the rather egregious, in many cases, examples of failure of risk management, failure of governance by JPM. So to minimize reported losses, the London traders deviated from the valuation practices that it had previously used to price the credit derivatives in the synthetic credit portfolio. Now, initially, the traders established a daily value or daily mark to market on their positions by marking them at or near the midpoint price in the bid-ask spread. It needs to be said that these products, these credit index derivatives, are very specialized instruments. The market for them is not that liquid. In fact, it's probably confined to just simply the 7, 8, 10 largest banks in the world. And on some days, there might not be any trading in this particular market on a particular product. So if there is no trade and no closing price available, then under IFRS standards, International Financial Reporting Standards, the requirement is that the mark to market be based essentially at the midpoint between the bid and the ask. Now, as these being the most representative of fair value. But as the losses started mounting, as you saw from the last slide, what the traders in London started to do was actually to move away from the midpoint idea and start putting marks on their positions which were most favorable from their point of view, in other words, minimize the actual mark-to-market losses at any point in time. Now, the question then arose when the Senate subcommittee looked at this as to whether in fact that really amounted to unauthorized or rogue trading on the part of the traders in London. And the Senate subcommittee concluded, and I think rightly, that no, the trading that was being conducted in London had been fully authorized by the management team in New York, and moreover, in line with best practice in risk management, the people in New York should have been double checking these marks to ascertain whether or not these were being marked at fair value. You can see here, again, this comes from a document that would have been subpoenaed by the committee. On the spreadsheet, this column here shows the distance between what should have been reported to the risk people in New York and what was being reported. And as can be seen here on this one day in March of 2012, the distance or discrepancy was close to $500 million. So this is really rather a shocking, egregious failure to comply with fair value accounting and best practice in terms of mark to market. The subcommittee also found that the whale trades exposed a culture in which risk limit breaches were routinely disregarded, risk metrics were frequently criticized and downplayed. The Chief Investment Office used 5 metrics, including VAR, credit spread widening, stress loss limits, stop loss advisories, and so on. And it turns out that these risk limits and advisories were breached more than 300 times during the course of 2012. An example can be seen on this screen, where we can see here there is a stop loss advisory, a mark to market stop loss advisory, which essentially should be scrupulously followed. So if the unrealized losses in the trading book, the SCP, move down below this roughly $70 million level here, minus 70 million, then the traders should exit their positions. They should take their losses and move on. But in fact, as can be seen here on this one day here, sometime in the first quarter of 2012, the unrealized losses actually came down to $600 million, and yet the traders maintained their positions and essentially kept rolling the dice. Another significant failing that was revealed by the Senate subcommittee was that JP Morgan, in view of the mounting losses, the mounting mark-to-market losses, etc., that we've just been looking at, the bank decided to change or abandon its value at risk model, the model that's designed to essentially provide a kind of loss level beyond which the bank shouldn't go. They asked their quant team in New York to come up with a brand new value at risk model based on different inputs to a model, different algorithms, and so on. And the effect of the new VAR model, as you'll see on the next slide, was that this cut in half the actual purported risk profile in the synthetic credit portfolio. But what JPM failed to do was to go to the supervisor in the US, the OCC, and ask their permission if they could change that model, and furthermore to get the model approved by the OCC. Moreover, they failed to disclose that they'd even made a change to the model in their regulatory filings during April of 2012. And as such, they did not disclose that the improved figure was the result of changing the VAR methodology, and that effectively masked the true risk that was being carried in the portfolio. This can be seen quite easily on this slide. So we can see here that the old VAR model, now this would have been the model that the OCC had signed off and agreed to. If the bank had kept that model as we moved into the trading in 2012, then the value at risk would have been way up here at 200 million, whereas the limit, which had again been agreed with the OCC, was set here at close to 100 million. Now, after the quant team in New York configured and redesigned the VAR model, conveniently the VAR being reported was conveniently under the $100 million level. I mean, this really is rather a shocking and egregious failure on the part of JP Morgan. So I hope you found that interesting, and it forms part of the ongoing resource that I'm developing on my YouTube channel, the Corcoran Codex, where I analyze critical ideas and episodes in the world of finance. I hope you will revisit from time to time, and I hope you will subscribe to the channel. Thank you for watching.